Guys, you have done qualitative analysis. I hope you have understood the entire process of qualitative analysis. Qualitative analysis. Now you have got your final comparable data set. But wait. Whenever you got that data set, just look into that data set first and compare that with your tested party's functional path. And then think that if there are more adjustments required either to your company or to your tested party or to that comparables, that you need to think first, right? Now if you have completed all the videos till now, it is good. Now we will go ahead with one more conceptual part, which is I call adjustments, or which is technically called as economic and risk adjustments, that are required to be done on comparables if need be, right? We don't do adjustments, or we don't undertake adjustments on comparable companies vis-a-vis tested party in usual course when we are doing transfer pricing analysis. But if need be, because there could be differences, higher differences in terms of risk and etc. Which is being faced by the comparable entities vis-a-vis the risk which are being faced by your entity, right, tested party. So there could be such differences also, differences on account of risk, differences on account of certain economic factors, and that is where it is better to go ahead and do the appropriate adjustments to the operating margins either of the comparable company or either of the tested party. Adjustments are basically you are doing that adjustment so that your comparability comes to more reliable part. It draws down to more reliable analysis. That is where you do the adjustments. But historically these adjustments have been into this litigation. So that is where it is important that you understand that first of all how these adjustments are to be undertaken and in what scenarios they are required to be undertaken. I'll share my screen to explain what are the types of adjustments that you can undertake, but ensure that before you undertake that adjustments, you are thorough with the concepts, you are thorough with the functional analysis, and then only you can go ahead and do the appropriate adjustments. I've also quoted some rulings also appropriately. You can go through that rulings as well. I'm sharing that files also, and you can make that adjustments in once when you to your comparable entities, right? I'll just share my screen to explain that particular concept. Now as you can see here, after I arrived at an operating margins of the comparable entities, that what we discussed under day 5. Now we are going ahead with the adjustments part, that is economic and risk adjustments. Now I will just draw your attention to OECD's para number 1.3. There is entire guidance on these adjustments also available under the OECD guidelines. I would request you to refer that, read that, all the public material available on adjustments, so that you get more and more idea on that adjustments part, right? But right now, for just to set the context, I have mentioned here para 1.3 of OECD transfer pricing guidelines, which says that when transfer pricing does not reflect market forces and the arm's length principle, right? The transfer pricing does not reflect the market forces and the arm's length principle. The tax liabilities of the associated enterprises and the tax revenues of the host countries could be distorted. Okay, so therefore OECD member countries have agreed that for tax purposes the profits of the associated enterprises may be adjusted as necessary to correct any such distortions and thereby ensure that the arm's length principle is satisfied. OECD member countries consider that an appropriate adjustment is achieved by establishing the conditions of the commercial and financial relations that they would expect to find between the independent enterprises in the comparable transactions under comparable circumstances. So this particular para allows OECD to adjust the transfer prices of the associated enterprise if need be. Now see, this is where the adjustment is being happening on the associated enterprise, and this provides that the countries are free to adjust that, and that is where in the India provisions also you must have seen that particular, that everywhere when we go ahead and we see that computation for method, ALP computation under each and every method, they are referring to the making adjustments. Now this is where the base lies, that this gives the country the power to make adjustments. Now we'll understand that there are various types of adjustments. First, I would like to start with working capital adjustment, which is the common adjustment of all types. Every time there could be this adjustments, not every time, but this needs to be made where there are significant differences if you can observe from the financial data of the comparable companies vis-a-vis the tested party. So now when this working capital adjustment is undertaken, so first, making a working capital adjustment is an attempt to adjust for the differences in the time value of money between the tested party and the potential comparables, with an assumption that the difference should be reflected in a profit. So technically, you will take this adjustment when you find there are differences in the working capital scenarios of the comparable companies as also with the tested party. Now, what are the steps how you should compute this adjustments? So before going into the steps also, I would request you to read the below file, which is the extract from the OECD transparency guidelines only, which provides for working capital adjustment. So from there you can understand that how working capital adjustments are to be undertaken. They have also given the example also how to compute this working capital adjustments. So under this particular part, first step is to identify the differences in the levels of working capital, and generally trade receivables, inventory and trade payables are the three accounts considered, right? When you are making a working capital adjustments, technically you are required to take these three parts, that is trade receivables, inventory and trade payables. Now I also just open that file so that it is easy for you to understand the step by step that what is working capital adjustments. I am just opening that file as well. Now, if you see here, this provides for a background of working capital adjustments that you can read. This is just an example, is what that they have given, and there is a why you have to make this adjustment. So you can read that particular part, and appropriately you can. I'll just move in this file to the example part. Now, what it says now. You can see here the example. So they have taken two parties, that is one is tested company and the other one is comparable company, right? So they have computed normal margin of tested party, which comes to around 0.8%, 1% for 5 years, correct? And they have also given the data of working capital that you would be also having for the tested party, right? What are the trade receivables, inventory, trade payables? I'll just wish to mention here, these are the average trade receivables. So this is not the closing balance. These are the average balances. If you read note number 1, they have commented on paragraph 8, which says that they are averages of this particular so opening balance and closing balance divided by 2. So it's an average balance what they have taken here for each and every year, right? So this is the data of tested party, right, where they have taken data of 5 years. In our case it will be 3 years because India provides for 3 years analysis, right? So you have to take 3 years when you are dealing with the Indian tested party and the comparables, right? So here tested party's margin is 0.8%. Now if you see the difference is, so net working capital, let me just put it that way, that is receivables plus inventory minus payables, it comes to 46 million, and if I divide that by sales, it comes to 25.16%. So this is the working capital to sales ratio, you can say that, right? For each and every year, this ratio has been computed. This is what the first step is, what that they are trying to say. Let me now just open the mind map as well. Now, what is this? Dividing the difference in working capital by appropriate base, that is sales, cost, asset, whatever you have selected under the PLI. Under this example, they have selected the base sales. So in your PLI, whatever you select as a base, you have to divide that particular portion of differential working capital with that particular base. Now, what you have to do ahead then you have to calculate a value for differences in the levels of working capital between the tested party and the comparable relative to the appropriate base, right? So now just a second. Now calculate a value for the differences in the levels of working capital between the tested party and the comparable relative to the appropriate base. Now the same thing that they have done for the comparable company as well. Now you can see here that in year 1, if you see for this particular, so this is the comparable company's data, year 1, year 2, year 3. So how many comparables would be there? For each and every comparable, you will be required to undertake this particular process, right? So Here we are just considering 3 years, we are not going till 5 years because the India TP provisions does not provide for going beyond 3 years. So here comparable company may be same, they have done the R plus I minus P divided by sales. So this is what the ratio of working capital to sales they have got in the comparable entity. Now if you compare this, it is 25.6%, which is higher. So tested company's ratio is quite higher than the comparable company. Now what you have to do here is you have to identify the difference, and then you have to multiply this with an interest rate, and then appropriately if the figure is positive, so then you have to add that in your particular adjustment in your comparables margin, and appropriately you will get a final adjusted comparable margin. Right now, what is this entire process and why this entire process? If you see the why, you will come to know that there is a concept of time value of money which they have applied. So it is presumed that in case if your tested party has more capital chunk in itself, like it had a very positive working capital, in normal circumstances it is 9% in comparable circumstances, while this entity has had 25% to the sales part. So more of the capital was there involved in working capital, more of the amount was you may say that it's there lying in the working capital. Now if that particular amount would have been invested somewhere else at a risk-free rate of return, then particularly what would have been that particular amount on which the interest would have earned, and that interest they have factored and they have added to the comparables margin. So in case of a reverse situation where the comparable, where the working capital was negative, particularly in that scenario, then they would have reduced the operating margin of the comparable entities. I'll show you that part also. So where the working capital, the difference between the working capital of tested party and difference between the working capital ratio of the comparable company has a negative value. So if you see here, if they have compared here with that particular interest rate, and that is where they have reduced the margin of the comparable company. So earlier the margin of comparable company was 2.59%. Now that post applying this adjustment, that is minus 0.23%, they have reduced and came back to 2.35%. Now see, this is these are adjustments which are to be made only if they are required to be made under that circumstances. You will be able to understand once you read this entire why. I am not explaining here entire why when it is required, but in general we have seen that people do make working capital adjustments to the transfer price, so that they are in line with the functional comparability criteria, right? So that is what working capital adjustment is all about. Now we'll move ahead to the next adjustment, which is risk adjustment, right? Now, what is risk adjustment? Now working capital adjustments that you need to understand from this particular workings, and let me know in case still you have doubts. Generally we don't undertake adjustments unless until it is required. Please have this principle clear in your mind. It is not every time that you are required to do the working capital adjustment. It is just when it is required, then only you are required to undertake that particular adjustment. Now risk adjustments. Now practically this risk adjustments I have not undertaken in any of my cases till date. Now this is a theoretical concept which has been also applied into certain regulations as well, where people have went ahead and gone ahead and made this risk adjustment to the transfer price, because obviously there was a difference seen, there was a difference which could be identified between the comparable companies and the tested party, and that is where they have taken this risk adjustments. I also quoted some rulings here so that it is easy for you to go through that rulings and understand that why this risk adjustments and in what circumstances that needs to be undertaken, right? So what is risk adjustment? Risk adjustment is undertaken when the comparable companies exhibit different business complexities and be at different levels of entrepreneur or other business risks relative to the taxpayer, right? This may include risk in relation to credit, foreign exchange, product liability or technological obsolescence. Now, if there are differences between risk of comparable companies which they are facing, and there's a difference between the risk which your tested party is facing, there's a gradual or big difference between that particular risk which can be seen, right? then you are then you may make this risk adjustment and appropriately adjust your tested party's profit, right? Now we'll see ahead. Now, further to understand what is risk adjustment is a method used to account for differences in the level of risk assumed by comparable companies when assessing the arm's length nature of control transactions. It is undertaken when comparing the profitability of a tested party, that is control transaction, with the profitability of a comparable uncontrolled transactions. The purpose of this adjustment is to create a hypothetical set of financial results. So technically, if you compute the actual operating margin of these entities, that would be different, right? As per that operating margin computation method, right? When you follow that operating computation margin. But uh, when you make these adjustments, you arrive at a hypothetical figures, right? That is when you arrive at a hypothetical set of financial results for the comparable companies that would reflect the risk associated with the control transactions. I have tried to explain this through example because there is no method in as like similar to working capital adjustment. OECD has prescribed that method and formula and all those things, but there is no particular prescription under OECD for this risk adjustments. Even it has been often observed that when the tested party is low risk entity or captive service provider and comparable companies are independent, so these risk adjustments have been taken. So if you go ahead with the rulings and if you read that, you will be able to observe that this risk adjustment has been undertaken where a tested party is a captive service provider and vis-a-vis the comparable companies are entrepreneurial entities. Why? See, why they are doing this adjustments is because why the TP consultant does this adjustments is because comparable companies, the entrepreneurial companies like Infosys or Tech Mahindra. Now this is just I'm just taking one example that there's a captive IT service provider in India, right, which is your tested party. Now, for comparable companies, you have taken comparables as Infosys or probably Tech Mahindra. I'm just assuming one example, right? Similar kind of companies you have taken, similar kind of big companies like they are available in database and you are able to this company set in all your criteria except certain functional part. But this companies set in all of your criteria. But these companies are entrepreneurial in nature, and that is where they face higher amount of risk compared to your tested party, and that is where the reason is that you are required to undertake an adjustment to lower their margins, because see, there is a risk return relationship, you must have heard, higher the risk, higher the returns, right? So these companies also earn huge profit of 30%, 40%. Now that amount of chunk of profit cannot be compared with an entity who faces a lower risk, because obviously it faces lower risk, so there is a concept of lower risk, lower returns, and higher risk and higher returns. Like similar concept is applicable in the lower case also. So that is where you go ahead and take that adjustments, right? And that is where we have observed that the whatever case law also I have quoted here, pertains to that part only, that they have taken this type of risk adjustment and they have this has been upheld before the courts as well, higher court. Now, also I wish to draw attention to the fact that there is no universally accepted method for computing the risk adjustment. Now, that is where your prudence will come into the picture, that that comparable entity faces higher risk compared to your tested party. Then how do you arrive and how do you put that into a risk adjustment? How do you do that adjustments? That will depend on your prudence as well. I have devised one example, but please note that that example is just for understanding this concept. All right, don't apply that particular part of example in any other concept unless until you are not sure, right? If you can go ahead and apply that, make sure that it is the right way to apply, because there could be change in situations, there could be different situations, let me just put it that way, and then appropriately you can understand that in your situation what would be the appropriate model to go ahead and apply the risk adjustment matrix, right? Now see, as I said, there is no universally accepted methods for computing risk adjustment, but we have seen in practical scenarios that there could be 2-3 ways to make this risk adjustments. So first is operating margin adjustments. So this approach involves adjusting the operating margin of the comparable companies to reflect the differences in risk. So if the tested party assumes lower risk, the operating margin of comparable companies may be adjusted downward to align the level of risk, right? So that is what one thing can be done. Then after it comes a risk premium adjustment. Now this method involves adding a risk premium to the operating margin of the comparable companies to account for the additional risk assumed by the tested party. The risk premium is typically determined based on the industry benchmark and other relevant data. Now they will add that risk factor. So in case if your tested party is a full-fledged manufacturer, vis-a-vis the comparable company are low risk facing entities, and in that case you can add that particular risk premium to the other entities as well, comparable entities, and you can appropriately arrive at arm's length margin or arm's length rate. Now discounted cash flow method analysis. A DCF analysis may be used to calculate the present value of future cash flows for the comparable companies. The cash flows are then adjusted to reflect the differences in the risk, such as by using a higher discounted rate for the tested party. So this is where you can go ahead and apply risk adjustment. See, these are all statistical, mathematical and economical concepts. I haven't practically faced this particular part in risk adjustments, but I have tried to research on that and I have devised an example. I will just show you that example. And before going to that, there is this rolling also of Motorola solutions, which I have enclosed in this particular video, below this particular video. You can go ahead, read that ruling. It also gives it also says on other aspects as well. It's a nice ruling, and where they have used the CAPM model to put that risk adjustment. But at the end of the day, it will be your judgment and your prudence that you should apply or not, that adjustment or not. So I will explain this cloning afterwards, but first I'll just go to the example which I have devised to explain the risk adjustment, so that it clears your mindset. Now, as you can see here, I have just devised one simple example. Okay, I have not taken very much more higher or complex things, but yes. So now the transaction under consideration is basically the tested party has sold some finished garments to the associated enterprise. Now the industry in which the tested party and comparable company operates are apparel manufacturing. Then geography in which tested party operates is India, right? These are certain assumptions which I have made right now. Correct. Then characterization of tested party is that the tested party is a manufacturer assuming lower risk and selling majorly to AE. So it is selling to the non-AE parties also, and it is also selling to the AE. But it assumes comparatively lower risk compared to its comparable entities. Now, going ahead, the characterization of comparable entities, they are full-fledged manufacturers which are assuming higher risk, right? Now, this is the operating margin earned by tested party on the cost is 99%. This is what we have arrived by making that computation. I have just assumed a figure here. Right. Now the operating margin of a comparable company A and B, which assumes higher risk, is 13% and 15%, right? Which is quite higher than the margin which is being earned by the tested party. Now how we will analyze the risk adjustment on this part? The beta coefficient is 6.05. For this beta coefficient, I have referred to, I would also request you to refer this particular website, which is a very known professor, Mr. Damodaran. So NYU, he's a faculty in NYU University since more than 30-40 years, and he has been into research of valuation, and he has his own website where all the data on this beta for every country or every region is being published, and he analyzes that part, and he makes valuations and he deals with all these economic aspects. So you must have also heard the name. If you don't know the name, you can just check his website also, Damodaran. He's a very famous personality in the entire world. He's a professor in NYU, and he undertakes all such. He's all day in and out in this valuation and etc. all things. So on his website, the reliable industry beta can be found out, rather than you taking that entire pain to compute the industry comparables, taking the comparables, then you need to compute the beta coefficient and etc. I've referred to his website. I've taken this data. I will give that link also. There are a hell lot of data on his website on valuations, beta, coefficients, correlations, regulations, etc. Whatever you might also not know in statistical purpose, that guy has done everything, and he updates that every year in the month of January to March. That data gets updated, right? So you can check his website and you can understand that what type of data could be relevant in your case, and you can use that as well. Right, now we have come to our main topic of adjustments. Now we saw that our entity, that is tested party, has earned 9% during the year operating margin, and while the comparable companies are earning 13% and 15%, but they are assuming higher risk, right? Now we need to arrive at a lower comparable margin, because we know that there are higher risks which are being faced by those entities, right? Now what I have done here as a layman, what I have done here is, first I have plotted certain risk here which are major for that comparable companies vis-a-vis for a tested party. What could be those? First is business risk. Now what in your case you will have to see the factual part, that whether that risk is there in your entity or not, right? And that is where you will be able to understand, and whether in your case the comparable entities also face that risk or not, that also you are required to understand and judge. Now if you see here, I have plotted four types of risk here. That is business risk, that is a risk due to loss in market or market share or business. Then capacity utilization risk, that is risk due to ideal or underutilized capacity. Then product liability risk, that is risk due to product failure or quality issues. And credit and collection risk, that is risk on account of bad debts. So these are the types of risk which are being faced by the tested party also, and the comparable companies as well. Now if you see here, I have just allocated or assumed certain percentage on this particular risk considering the market conditions. I have also provided justification for why I have taken this particular percentage. Now if you see here, for business risk I have taken 100% risk. Now in case of business is lost, then everything is lost. So 100% I have allocated that percentage of risk as 100%, right? Now I come to capacity utilization risk, which is risk due to ideal or underutilized capacity. So I have assumed that probably it may happen that after understanding the industry standards as also comparable companies data, we may come to know that under comparable companies, out of 30 days they are working, 2 or 3 days there is an idle manpower which is sitting in the factory, right? And that is where I have just divided by 2 divided by 30, that is 6.67%. So after 30 days of working, 2 days they are not working, and that is where there's a loss, or you can say 6.67% of entire production doesn't happen, and that's where I have just factored that particular multiple at 6.67%. Now product liability risk, so out of 1000 products which that company is selling, which the comparable companies are selling, or probably in the industry itself, there is this risk of product liability, that is product damage, that is 0.3%. This is just an assumptions. In your case it will be always different. And bad debts risk, that is credit and collection risk, that is 5%. So this I have taken from the comparable companies. I have divided that particular thing by sales. I arrived at one ratio and put at that part, because that's a risk. So if I sell 10 rupees or 100 rupees product, 5 rupees I am sure that I will not get back if I am selling that particular part on credit. So this is the risk which I am facing right now. Now what I have done is, I have given this weights of this particular risk to the tested party and comparable companies. So how I have given the weight is, I am putting one number for low risk and 3 number for higher risk, right? And for medium risk 2. This is what the weights I am giving right now to this tested party and comparable companies. So now in case of tested party, if you see, the tested party faces business risk obviously, because it is dealing with third parties also, apart from selling the goods to A's. But compared to the comparable companies, it is facing lower risk, right? So that is where 1.25 weight I have given to tested party, and 2 weight I have given to the comparable company. Correct. Now capacity utilization, I have studied the data and I have understand that tested party comparatively faces lesser risk as capacity utilization risk, vis-a-vis the comparable companies are facing higher risk, right, with respect to the capacity utilization part. Then after product liability risk, again that risk is being averted or being faced less by the tested party, and which is being faced highly by the comparable companies. These are weights which I have given basis their risk matrix, right? And credit and collection risk, as tested party does not face this risk, so I have given this 0, while comparable companies do face this risk, and it's a high potential thing that they may face. So that is where I have given them a 3 number. Now this is what the weights which I have given. Now as a next step, what I will do is I will compare this particular weights and risk of tested party with the comparable entities, right? And appropriately I will derive at a differential part, right? Now if you see here, I have multiplied this particular level of weights with the risk factors or risk percentages that you can see from here, right? So under business risk, I have multiplied the 100% with 1.25 and this 100% with the weight which I have given, that is 2 to the comparable entities. Now likewise I have compared all such, I have arrived at a product for tested party and a product for comparable companies, the sum of that entire multiplications, right? Now I have arrived at a differential, so I have totaled them, and then appropriately I can understand that my tested party faces the risk quantum of 132% vis-a-vis the comparable companies faces the risk of 236%. So obviously the comparable companies faces higher risk percentage compared to the tested party. And what is that percentage? That percentage is 104. So that's a differential percentage which the comparable companies are facing. So if I convert that into a comparable, so for comparable companies, they are facing 104% higher risk compared to the tested party. Now further I have, so this was the difference, right? 104%. This is the difference between the risk being faced by tested party and risk being faced by the comparable companies. So I have divided by 104% divided by the entire risk faced by comparable companies, because I need to adjust their margin. So what I have done is I have divided this 104 by 236% and appropriately I have arrived at 44%. Correct? So now why this is there? Because that 44% is the amount of margin reduction which I will do from comparable entities margin what they have earned. So technically what I will do is, as you saw that operating margin of comparable entities was 13% and 15%, I will reduce 44% from that particular two margins. You can see here in formula which I have done. If you see here, from 13% I have reduced the 44%. So I have arrived at a adjusted comparable margin of 7.27% for comparable company A and 8.39% for comparable company B. Technically I have reduced the risk allocation or risk portion from their margins and I have arrived at this particular margins. Now if I just total or if I average out this particular part, I will get 7.83 as average, which I can compare with 9%. This is how I have undertaken the risk adjustment. This is the methodology which I have thought upon and which I have put down in the numbers, and I have assumed a situation that in my case if this situation would have come up, then how I would have dealt with that such type of situation. So this is what I have put down. See, you are not required to undertake adjustments unless until you are bound to do that, right? Unless until your profitability does not matches to the comparable part. Till that time you don't go ahead and do the adjustments. If it is required, go ahead and do that. Find out a way to do that. But every time we don't do this adjustments in the TP report. All right. I hope this clarifies. Now that is how we do the risk adjustment. I'll be saving this file and you'll be getting these files particularly below this video. Now we come to that judgment of Motorola also. It's a interesting judgment. I'll just read the facts, and you can also check the analysis which the ITET has given. This is just for reference. Please don't, there is nothing computation of risk adjustment has been given, but this judgment I have quoted because this is a good judgment, and you can read this judgment to understand the transfer pricing aspects which revolves around a transaction which has been undertaken by a captive service provider with its holding entity. So what are the facts of this judgment? The assessee was remitted on an arm's length basis, that is, it was compensated for all its operating costs plus a pre-agreed markup rate. Correct. So the assessee undertook a minimal business risk as against the comparable companies that are fully fledged risk-taking entrepreneurs. Same situation. Correct. So the taxpayer, so what was taxpayer's stand? Taxpayer's stand was the taxpayer furnished the computation of risk adjustment on account of market risk difference following widely accepted method of capital asset pricing model. that is CAPM, on the basis of which the amount of adjustment work out to 6.9%. And thus the mean margin computed by the TPO as the ALP based on his comparables, which was 26.71%, had to be reduced to 19.8% using the CAPM formula. Correct. So there was this reduction being done to the extent of 6.9% from the comparables, and appropriately the margin of comparable entities, which was 26.71%, which the comparable companies were comparable companies were full-fledged entrepreneurs. They did this capital asset pricing model, they applied that model and came to a risk adjustment of 19.8%. Now capital asset pricing model is what basically is a financial model that calculates the expected rate of return for an asset or investment. Correct. So that is how you can compute the expected rate of return for an asset or investment, and CAPM does this by using the expected return both the market and risk-free asset and assets correlation or sensitivity to the market. So that is how CAPM works. I've just given basic understanding of that particular part, and the analysis of that particular part is being given under the para number 118.1 to 120. Now that is what the entire thing is all about, risk adjustment. I hope this clarifies. I'll catch you in the next video when I'm going to explain the other adjustments also, and then we'll go ahead and we'll understand the preparation of economic analysis and TP report. But before that, we'll understand these two adjustments in the next video. I'll catch you in the next video. Thank you.